Hello listeners, this is Abhishek Lahoti, Assistant Vice President at ICRA Limited, and through this podcast, I will be sharing ICRA's outlook on commercial real estate, covering office leasing and retail mall developers. Starting with office leasing segment, ICRA estimates that the net absorption of commercial office leasing across the top 6 cities in India, which includes Bengaluru, Chennai, Delhi NCR, Hyderabad, MMR and Pune, is likely to increase by 10 to 11% to 59 to 60 million square feet in FY25 and witness a further growth of 3 to 4% in FY 2026 on a high base. Despite an influx of huge supply of 125 to 130 million square feet in FY25 and 26 put together, the vacancy levels are expected to remain range bound at 14.5 to 14.7% by March 25 and improve to 14 to 14.5% by March 26, supported by resilient absorption trends. Office leasing activity remained firm with net absorption of 54 million square feet in FY24 and 44 million square feet in 9-month FY25 for the top 6 office markets in India, supported by strong demand from global capability centers and domestic corporates, increase in physical occupancy in office spaces, and revival of IT SEZs with regulations around floor-wise denotification. This has resulted in 70 bps decline in vacancy levels for top 6 cities to 14.7% as of December 24 from March 24. On overall basis across top 6 office market, the healthy absorption trends are expected to continue in the medium term and occupancies are expected to reach decadal high by March 2026 to 85.5 to 86%. Overall, the credit profile of ICRA's sample set of office players is expected to remain stable, driven by healthy growth in net operating income, backed by rise in occupancy and higher rentals, and consequently, leverage and coverage indicators are expected to remain comfortable. Moving to retail mall developers, ICRA expects the rental income for retail mall operators to increase by 7 to 8% year-on-year growth in FY25 and 8 to 9% in FY26, driven by healthy occupancy levels, growth in trading values, and rental escalations. Across the top 6 cities in India, new supply of 9 to 9.5 million square feet is expected in FY25 and 26. The vacancy levels rose to 21% as of December 24 due to higher new supply, which has become operational recently and is yet to ramp up fully. ICRA expects the occupancy levels to sustain at 80% as of March 25 and remain at similar levels by March 26. The consumption growth for ICRA's sample set of retail mall operators is expected to moderate to 6 to 7% in FY25 compared to 9% in FY24 on account of the slowdown witnessed in H1 FY25 due to general elections, heat waves, and the extended monsoons. Consumption is expected to ramp up in H2 FY25, driven by the festive and wedding season. In addition, segments like hypermarket, food, apparel, and jewelry are expected to drive consumption with recovery in family entertainment sectors. Trading values are expected to witness 8 to 9% year-on-year growth in FY26. However, the increase in digital penetration and continued threat from e-commerce and Q-commerce players, particularly in the retail fashion segment, which is extending to some of the premium brands, is a major challenge for retail mall developers. Overall, the credit profile of mall operators is expected to remain stable. Thank you for listening and stay tuned for our upcoming podcast.